Hi, everyone. Thank you for joining us, bearing with us. Glad to have you for our latest peer analysis and balance sheet strategies webinar. My name is Andrew Paolillo, and with me for the first time, literally with me here, as we are having some audio visual difficulties, is Sean Carrer, who is our newest addition to the strategies team here, and we're very excited to have him on board as he brings an awful lot of experience, most recently as the treasurer of two multi-billion-dollar member banks here in the greater Boston area. So if you are with us for the first time here, what we plan to do is talk about what's happening in the markets and the economy, what's happening in the member balance sheet, some key trends that we culled from second quarter call reports. And then we're going to wrap it up with some actionable ideas and strategies that we can deploy on both sides of the balance sheet. So before we jump into markets and the economy, Sean, like me, is a avid baseball fan and yield curve observer. We did some data analysis, and we found out that there is a correlation, not really, between the 10-year Treasury rate since Sean joined us in the end of May, as well as the Red Sox playoff probability odds, according to Fangraphs. And you can see that through June, rates spiked and Red Sox went on a little bit of a hot streak, but then it kind of withered away as we made it through July. So essentially, if you're asset sensitive and you want to see the Red Sox play in October, you have some reconciling to do on which one matters most to you.
I think that's about as speech as a Super Bowl indicator.
Yes. So let's jump right into what's happening in markets and on the economy. The first thing we'll do is throw out this question here, let's see here. And we'll just throw this question out to the audience to use our crystal ball and look ahead on the chessboard. And when do you think that the Fed will pivot and begin cutting rates? And I don't see the poll question here. Usually get a chance to vote on that, but that's okay. We can skip that. So we'll just we can mentally record that. And I'll ask, when do you think the Fed will pivot and begin cutting rates? And it's interesting that, here we are in the midst of the hiking cycle, and we're already talking about cutting rates. And as Sean will get into a little bit later, the yield curve is already starting to talk and think about that. So certainly it is a valid concern. The second half of 23 is really where many folks are thinking that the possibility exists. So let's get into markets. So not very surprising, the Fed has taken policy rates up by 225 basis points over the last few months, and accordingly, market rates, whether it's the Treasury curve or something like SOFR, accordingly get dragged along with it. So you can see the changes from August to March have been approximately 200 basis points or so. Where we do see a little bit of a drift is in the 1-year part of the curve, the 12-month Treasury rate. And that makes sense intuitively, right? Because if we think about it, as you drift further out the curve, the impact of those rate hikes become muted. And it's not just simply a reaction function to what the Fed is doing with policy rates, that it is more supply and demand driven and more about the risk on and risk off sentiment from market participants. So, we've all seen and heard that, okay, well, the Fed is raising rates, they're tightening conditions in the economy. Well, that's supposed to mean that excess liquidity is going away. So you look at something like this, which this shows the balances in the rate on the RRP, which is the reverse repo program that certain market participants can do in transacting with the Fed. And since the beginning of the year, balances have grown from about 1.5 trillion to comfortably over 2 trillion at the moment. So, how do we reconcile that and say, well, that doesn't seem very tightening-like or draining of excess liquidity? And what is happening is that the money is not leaving the system, the larger financial system, but it's shifting, out of the banking system and into other entities like the money market mutual fund complex, where there is a scarcity of short-term assets. So the lack of T-bills for them to buy, even if you think about something like the rate available on this overnight transaction with the Fed at 2:30, contrast that to 1 month T-bills today at 2:15. Well, then it's really a no-brainer for, if you're a money market fund, to be parking your money here. So now, certainly as we're off 0%, and as most folks on this call can attest to, many depositories have lagged passing through the hikes in terms of their deposit rates, although that's what's happened thus far. It's our view that that's not going to happen for much, much longer. So here is where we see the money moving from the banking system to the other participants within the financial sector. Sean, you want to talk about short-term rates?
Yeah, absolutely. So, as Andrew alluded, the market is actually starting to begin to price in the chance of cuts in the future. If you look at a graph of sort of 1 month forward swap rates and so forth, you can see that the market is pricing in aggressive continued hikes later into the rest of 2022. But at some point in 2024, the market is thinking that we'll start to see actually some rate cuts. If we take a look at this particular chart, what this is really highlighting is that the Fed has articulated a long-term neutral rate of about 238, and that number is just the difference between 225 and 250, the range of current Fed funds target. And we're already at that point. And so the Fed dot plot, which is sort of the expectations, the set of expectations that the Fed governors identified, shows that they're going much beyond what they are identified as their own neutral rate in the immediate future, up to as high as about 375. I think futures are calling for 50 basis points in September and another 50 to 75 after that. But then it's showing, as you go further out, we get right back down to this sort of 250 level before very long. Curve steepness, and it's put in quotes here because obviously I think a lot of folks are starting to feel this. The curve is pretty significantly inverted. 2s, 10s, which is usually the marker that people like to look at for sort of a recession indicator or for the general yield curve shape. Negative 43 basis points yesterday, similar to that this morning. And what this graph is showing us is basically what's happened between 6 months, a year and 3 years, and then a little bit longer out. And what this is just trying to highlight to us is that early this year we had significant steepness. I think a lot of folks benefited from that on spread lending. But right now we're seeing no steep. In the very beginning we're seeing some steepness because we still have these short-term rate expectations, but longer out we have very significant inversions that are being observed, and a more significant inversion than we saw a few years ago.
So back to Fed watching here, and the Fed has a dual mandate to keep employment and prices at relatively stable and low levels. So when we think about unemployment and jobs, the Fed's doing a fantastic job in that regard. We had a fantastic jobs number come out last week, and we're comfortably below that 4 to 5% level that they have cited as being indicative of full employment. When we come to prices or inflation, certainly as we all know and hear and see in the press, that is a different story. And although last week the inflation print was relatively promising, and you have to take my word for it, but we put these charts together before the debate really picked up about the difference between month over month and year over year inflation. So, the headline numbers that we see are quoted in terms of year over year changes. Those are those headline 8-9% numbers. But month over month, if we look in the bottom right, we see that, we saw a departure from the transitory, or is it not transitory inflation that we saw for the bulk of 21 and 22, and we actually saw the index slightly decline. But looking at that top graph on green, in the green, we took an example of March 21 when inflation really started to heat up. If things had continued on a path of a 2% year-over-year rate, that's that dotted green line. Where might we be? Where might we be? So we can eyeball this chart and see that even if for the actual CPI we were to go sideways for a period of months like we did last month, to get back to that normal level, to course correct, it is going to take us a number of months into 2023. So again, in terms of the two different things that the Fed is balancing and causing challenges, they have the main tools in the toolkit being rate hikes and the reduction of the balance sheet. And the reduction of the balance sheet, as we've talked about before, is tricky with the MBS portfolio, given the current level of rates, that prepayments certainly are not helping shrink the balance sheet at all. So here we can see in the three different periods that we've had over just the last year, where the Fed went from quantitative easing, significantly ratcheting up bond purchases, to tapering the purchases, to technically in tightening mode. We can see they really haven't begun to decline the level of the MBS holdings. So to the extent that rate hikes can do the job, that gets away from that tricky, tougher to execute upon challenge of shrinking the MBS portfolio. So talking about MBS rates, which have left the screen here. Bear with me for a second. You'll have to take my word for it that MBS rates, mortgage rates, excuse me for 1 second, everyone here. Mortgage rates in the beginning of the year were obviously much, much lower than where they are right now. And one of the things that also came into play was it wasn't just that the rate was higher, but spreads were wider as well. So as balance sheet lenders, everyone knows that it's not just about the rate, but it's about the spread. So as rates have come down from the high fives, even into the 6 range, so has the spreads come down a little bit. And one interesting nugget to pass along, something that we heard at pretty much every meeting that we had with members over the last couple months, that when rates were backing up higher and higher, the folks had to price below quote unquote market rates in order to capture volume. And we're going to see the impact of that in a little bit when we look at what happened with loan growth in the quarter.
This next chart just kind of highlights the fact that there seems to be some level of incongruity right now between sentiment and what's actually happening in markets. The X's on this graph represent Community Bank's Sentiment Index, which is a new index that started about 3 years ago that polls community bankers on 7 different attributes and how they feel about their institution and how they feel about the economy and how they feel about sort of the general macro environment versus what the NASDAQ Community Bank Index is doing. And what we see here is, in the last quarter, the Community Bank Sentiment Index actually recorded its lowest level in its relatively brief 3-year existence. But the overall stock market hasn't reacted in the same way that we're feeling as community bankers right now. If you dig into the components of that Community Bank Index, there are 7 different components. The 3 pieces of the puzzle that are really weighing it down are macro business conditions, regulatory environment, and monetary policy. So a lot of folks out there right now are concerned about sort of the effects of what the Fed is doing and what that might augur for future business conditions. The good news is, if we can look at regional GDP performance in recent times, we know right now there's a bit of a debate about, are we in a recession technically or not right now, because there were 2 quarters of negative GDP trend. But the good news is, here in New England, in Q1, which is the most recent available data on a state-by-state level, every New England state actually outperformed the national average on GDP growth, which is interesting to observe. And if we take a look on the right-hand side of this for cumulative GDP growth since the onset of the COVID environment, 4 out of 6 actually have outperformed the country generally. And New Hampshire has been a real standout, something that I haven't heard a whole lot about, but of the 50 states, New Hampshire's actually had the best GDP performance since the onset of COVID. And Massachusetts, Rhode Island, and Maine also outperforming nationally.
So let's switch over to section 2, where we're going to take a deeper dive into some key things happening on our member balance sheets. So those who have participated in this webinar in the past know that we try and come up with new and exciting ways to look at a pretty boring part of the balance sheet, that being simply cash. And with the excess cash in 2021 and 2020 and 2021, we're happy to report that we're just about back to normal, pre-COVID levels of cash on member balance sheets, more so for banks than credit unions, in that 4 to 6% range. And Sean will get into a little bit further with some of the loan growth and net interest income and net interest margin statistics. Is that unsurprisingly, that is generally obviously a good thing for all involved. So what is driving this reduction in cash? Is it loans or is it deposits? And from our perspective, the quantitative and the qualitative, unequivocally we can say that it's due to phenomenal loan growth and activity. So here is one way that we look at things, and we look at the percentage of banks or credit unions who had quarter-over-quarter loan growth or deposit growth. And what we saw was last quarter, 75 to 80% of members had loan growth. And if you take out what happened in June of 2020 with the onset of the PPP, so that's really an asterisk as it relates to loans coming into the balance sheet, that this was a fantastic quarter. And you see that evidenced in the tables below. So those numbers for the median growth rate for banks and credit unions, those aren't annualized. So if you take those 3 to 4.5% loan growth numbers, you're talking about 15 to 18% annualized levels, which I would imagine, when you're in budget season, if you're putting in those types of numbers, you're probably doing backflips and multiple backflips at that if you were to think about realizing those types of levels.
Yeah, I mean, if we put this sort of in context with each other, so to kind of Andrew's point around loan growth relative to deposit growth here, this chart takes a look basically at the past 6 months or so of, or the past year rather, of cumulative bank deposits minus loans. And this is just banks because it's what's available on the Fed website. And you can see that, early this year, about 6 months ago, we actually peaked at deposit growth significantly outstripping loan growth. But really, since the end of Q1, we've seen a really steep decline in that. That is to say that loan growth has really seriously outpaced deposit growth. In fact, just looking at these numbers today, average deposit growth, sort of on a 4-week rolling average, just because sometimes week to week can be a little noisy, cumulative bank deposits are actually virtually unchanged in the past 5 months. Something else to kind of think about as we head into strategic planning and budget season. But deposit growth basically hasn't been there in the past 5 months. But loan growth really has been, because there have been such cash levels that have built up. People are spending that cash and remixing into loans. To turn over to the next one, was asset size a factor in this kind of growth? And generally what you see is, yeah, I mean, the larger institutions have had a higher percentage growth, irrespective of the actual balances. The actual percentage change is higher for the larger institutions, especially on the lending side. Deposits, it's a little bit noisier. It's not quite as clean as the bigger you are, the more loan growth you've had. But it is still directionally the case that deposits have been a little bit stronger at bigger institutions. That having been said, if you kind of scale back and take a look at this, loan growth 4 or 5%, just like Andrew's talking about, high teens is what that argues for, sort of annualized. Deposit growth basically flat, basically a fraction of a percent. Some institutions down, some institutions up, but very flat. And if we look again, if the macro is any indication of our membership, Q3 is no different. It's basically been flat. So if you're struggling at deposit growth right now, you're not alone. You know, geographically, again, kind of zooming in on some of the particular features of our particular region here. You know, CRE growth in Maine has been really strong. Mortgage loan growth in Massachusetts has been really strong, and credit unions have had really strong auto loan growth. And so, you know, again, I think that highlights some of the pieces that we're talking about that New England has sort of outperformed nationally, especially this year, it seems, and generally since the COVID environment. But this trend of very strong loan growth has been going on for a while now. If we take a look at NII decomposition for member banks, you know, overall NII for banks this quarter was up about 9.5%, which again, just in a single quarter, 9.5%, extremely strong growth. We lost the numbers here, but it's about $240 million of actual NII growth that happened within the quarter for banks. And if we have a kind of a breakdown here about, was it volume, was it rate, was it mix? What actually contributed to this? And was it asset, was it liability? Given everything we've said here, probably no surprise that this all happened on the asset side and nothing really happened on the liability side. And in bank space and NII, it was actually the rate resetting that actually created the biggest variance in NII. That is just the fact that rates have risen so much and banks generally have been asset sensitive, created the expansion in NII that we saw. The loan growth also really important factor here. It's about 60-40, about 60% of the result was from the rate regime and 40% from the loan growth. On the liability side, there was very little change overall in liability. Liability volume, like we've been talking about here, hardly any change in deposit growth, so that didn't affect the numbers a whole lot. And rate, again, we'll take a look at this in a second on NIM, but there hasn't been a whole lot of changes in deposit rates, at least as of Q2, as folks lag pricing that's happening in the market. Turning over to credit union results, you know, credit unions up about $40 million in NII, and that's about 7% quarter over quarter. Not quite as strong as the bank space, but still extraordinary for 7% for single quarter growth. And this is slightly different than the other story. It seems that credit unions aren't quite as asset sensitive as our bank members. And that, you know, the volume accounted for the 60% of the change and the rate change accounted for about 40%. Again, liabilities were much less key in this quarter's results because we had such rapid rate increases and such strong loan growth and such strong remixing away from cash into higher yielding assets. So, you know, results for NII really an asset-based story, both for banks and credit unions. If we turn this into just NIM, just pure NIM, and take out the factor on growth. So if we look at NIM and say, was it rate or was it mix on the balance sheet? And overwhelmingly it's rate. Even though we had all that remixing, even though we had the cash going to the higher yielding asset, overwhelmingly what created results was just higher nominal rates across all of the asset classes. You know, for banks, up over 16 basis points in NIM, and over 17 basis points of that happened because of asset repricing. The mix was worth a little less than a basis point. Liability side, you know, the liability rate only about 1.8 basis points. And if you get a little more granular on that, it's about 1.5 basis points on deposit rates. So that is to say that within Q2, at least with the data that we have presently, you know, overall bank deposit pricing only increased 1.5 basis points despite the fact that the Fed raised so aggressively. Kind of shows that there's probably a lot of room to change there. Liability, it's hardly changed in terms of overall mix. On credit unions, again, similar story. It's a very strong result. It's not quite as asset sensitive as the bank space. About 9 basis points on them overall. And somewhat curiously, at least to me, is the fact that liabilities actually got a little bit better. Actually, liability pricing got slightly better. We don't have the same level of data on credit unions as we do on banks, so there's a little bit of speculation here. It's not quite as precise, but it seems very likely that overall liability pricing in credit unions is actually slightly better for the quarter. But again, overwhelmingly, it's asset yields overwhelmingly created the 9 basis point improvement. Again, 9 basis points in a single quarter is extraordinary. And then we just take a look at our membership mix. So again, this is all members, and on the prior slides too, bank members or all members 100 billion or below in assets, and then all credit unions. we have 187 member banks that meet that criteria, and 22 banks actually had really extraordinary results of 30 basis points improvement in the single quarter, and 86% of banks overall showed some level of NIM improvement. I've seen some different industry estimates on that about what percentage of banks are actually asset sensitive or not, but I've never seen anybody suggest that 86% of banks are asset sensitive.
That's good, right?
That's good,
yeah.
At least for the quarter. But it does feel like we're stretching a rubber band on liability pricing. I guess we'll talk about some of that in a second. But again, the mean result there, 16 basis points, the median 14, it goes to show that in bank space, about 12% of banks really outperformed this quarter and did very well. Credit unions, mean and median are the same at 9. I guess the bigger story here is that the central tendency within credit unions is a little stronger than it is within banks. There's more variance within banks than we saw in credit union space. But in both, whether you're a bank or credit union, asset sensitivity, NIM expansion, that was the theme for the quarter. If you saw NIM declines this quarter, that's sort of an outlier.
So Sean threw some great positive things out there. So I'll segue into everybody's least favorite thing to talk about is unrealized losses in the investment portfolio. So certainly this has been a hot topic, and let's provide some context here. So the median unrealized loss in bond portfolios for credit unions was about 9%, a little more than 9%. Banks about down 8.6%. So this compares to at 3/31 about 5-6%. So things got a little bit weaker and softer in the second quarter. Now, however, here we are about a month and a half away from June 30th. These numbers have probably moved in your favor a little bit, given the movements in the yield curve and change and spread tightening on some of the assets that you're going to find in there. So it's moderated a little bit. But that noisy scatter plot there is meant to show the other comprehensive income as a percentage of assets, to put it in context for the whole balance sheet, not just the 8 or 9% within the sleeve of the investment portfolio. And then also as a function of overall capital ratios. So you can see the median AOCI as a percentage of assets is about a little more than down 1%. Now that is skewed because, as you can see on the very top there, there's a lot of banks and credit unions who have 0% AOCI, whether it's because they don't really, their investment portfolio consists of just sitting in cash, or they, as we'll see in a little bit, they heavily utilize held to maturity or whatever the case is. But certainly as our, when you look at the with the intersection of capital ratios and the AOIC adjustments, you're probably looking at that tangible equity level that's lower than it's really ever been when you put those two things together. Now, held to maturity, if we could have a time machine and go back and put all our bonds back in the first quarter before rates went up into HTM, we probably should have, but obviously that's not the case. And what's interesting is that over the last handful of quarters, we have seen an increase in usage of the held to maturity designation. Not really as much as I would have thought, given the magnitude of the excess liquidity and the change in the loan to asset ratios, right? You can see on the left-hand side about a 4 to 5% improvement, or excuse me, increase in usage of held to maturity. And you would think intuitively that you have a lower loan to asset ratio, you can justify using held to maturity. And while there was some relationship there where the folks who do use held to maturity tend to have lower loan to asset ratios, again, it's not really to the magnitude that we would have thought, considering that in 2020 and 2021, we saw many folks who were at 80 to 85% loan to asset ratios, and then just in a few quarters time went to 55, 60%. So Sean mentioned, GDP, softer GDP, is a recession coming, is a recession not coming? And bankers always, when they hear those things, they think about credit. So here's one way to look at credit, the adjusted Texas ratio. So we're not accounting for, there's that acronym again, AOCI.
Yes.
I think I got it that time. So this doesn't account for that. So essentially, you want to be in the bottom left of this chart, obviously, right? And if you are towards the right, you'd rather be on the bottom, and that is because we're comparing where you were 2 years ago at the height of the COVID uncertainty versus where you are right now. So any way you slice it, when you look at the components of non-performing assets or equity or the loan loss reserves that are built up to cover for any potential bumps in the road, our depositories are well positioned. And I think part of it probably ties into the points about here in New England, the stronger and hardier level of economic activity. So let's wrap things up and get into balance sheet strategies. So certainly, as we've seen conditions change, and in just the last few months, and even looking over the last year, that's to folks like Sean and I, this is interesting and fascinating because it really pulls the whole menu of asset decisions and liability choices into the equation. So, the first thing that we'll talk about is, the fact that we talked about fantastic loan growth. We talked about deposits stalling or even arguably receding, and attractive investments on rate and spread, but unrealized losses are causing some bumps in liquidity metrics. So you put all those together, and it's probably no surprise that there's been a very, very sharp increase in borrowing activity amongst our depository membership. So if you saw our quarterly earnings announcement, you'll notice that our outstanding advances went from about 12 billion to about 30 billion in just one quarter's time. So here's one way that we look at it and look at the percentage of members who have increased on a quarter-over-quarter basis. So you can see versus the 5 to 10% levels that we saw in 20 and 2021, that jumped up pretty significantly here in the second quarter of 2022 to between 30 and 45%. And we broke this out by banks and credit unions and also the size dynamic. And within our membership base, there are those who are relatively inactive even before the heightened liquidity. So when you remove those, you're probably looking comfortably at a majority of folks who had to tap wholesale funding within the most recent quarter. Sean again gets to talk about the fun stuff.
I like that. This is one of my favorite topics. It's talking about the fact that the dividend, here at the FHLB has actually increased very significantly. Andrew alluded to quarterly results that, the banks, the FHLB's growth in the past quarter is about 150%. And the dividend, has increased very significantly. Indexed to SOFR and based on the average rate of SOFR outstanding throughout the quarter. But the actual spread that you're seeing here on the left-hand side went from 200 to 300 basis points as SOFR is rising. So it's sort of a pro-cyclical effect as rates are rising, as advances are outstanding. There's more profits and there's better dividends. And so if we do some quick forecasting on that, SOFR is likely to average above 2% this quarter. And if we continue to have that 300 basis point spread declared by our board, that would argue for a greater than 5% dividend, a low 5% dividend. And if we do the math on that versus the activity-based capital stock requirement that's associated with taking new advances, that works out to about 20 basis points of spread. And it could go even higher in Q4 as we go along. And so, if we think back just a couple of years ago, that number would have only been about 7 or 8 basis points. Now it's 20 and climbing. And that's definitely something to consider as we're evaluating different funding choices. The higher FHLB dividend really helps make some of our offerings more attractive than some alternatives. And here's something else again, I guess, to Andrew's point around giving me the opportunity to talk about some of the fun stuff or some of the bigger opportunities out there. Short-term advances, we've had a number of calls with folks in the past couple of weeks. There's been a real opportunity in short-term advances being below Fed interest on reserve balances. So, probably everyone's aware that Fed IORB is 240. A lot of our short-term advances, 1 week, 2 week, 3 week, have been below that consistently now for the past several weeks, almost a month. I think today, the 1 week advance has been around 236, 237. It gives an opportunity for some level of potential arbitrage there, especially when you factor in that dividend, all in 236, 237, 238, whatever it might be today, goes to 216, 217, 218, keep it in cash at the Fed at 240. There's just an opportunity there, especially for a lot of members who have been kind of, might be rusty in taking FHLB advances because they've been flush with cash since 2020. Could be an opportunity there to kind of brush off, get rid of some of the cobwebs, and borrow short term, actually have a profit.
So another area where we have seen a considerable jump in activity and interest is with our HLB-Option advance. And again, that is a function of the alignment of market conditions being favorable, but also there being balance sheet needs that line up with that. So if you're not familiar with this product, it is a fixed rate borrowing where the member grants the Home Loan Bank the ability to put the funding back at specified intervals. And because of that, you get lower rates, in some cases, much lower rates than comparable classic rates. So here's an example of a strip of structures. And again, it's highly customizable between the maturity, the lockout date, and the call frequency. And we're comparing the posted rates relative, again, to interest on reserves. And you can see for a good number of structures that the available rate is below IORB, and then certainly as well below treasuries or swaps or other types of market rates. So how and why does that happen? Well, because as we've talked about with the potential Fed path, that we are in a very volatile and uncertain environment, and markets price that accordingly. And then you throw in the fact that the yield curve is flat or inverted, depending on which tenors that you are looking at. And then that's how you get to where this type of advance can be priced well below other examples. So to point out two examples here, a 5-year maturity with a 3-month quarterly put option, pricing at 206. So comfortably below the DCM rate, as well as the 3-month alternative. And then the other example of the 10-year, 2-year, where to the 2-year mark, it is about 100 basis points below the 2-year bullet. So to give you 3 use cases on how and why members have been using this, is first to defend against deposit volatility, and Sean's going to get into that in just a minute. When you think about this is not too dissimilar to if a customer had walked into your bank and said, I want a long CD, but I want the ability to prepay it with no prepay fee. Well, you would lower the rate versus the bullet rate. So that's what's happening here. If you're asset sensitive and you want to mitigate that now that rates have risen and put some down rate protection in, then this is an efficient way to do that. And on the liability, and for those who are liability sensitive and started to feel some of that margin pressure in the last quarter or two with rates starting to rise, well then, certainly with the longer lockouts, this is a way that you can nudge out your funding duration and maybe alleviate some of that pressure.
And probably, just a quick highlight on that. The structures that go out in the email aren't the only available structures. There are opportunities to structure those as you see fit. That's worth the call. Deposit now. So as we think about this environment, deposits being very flat in the past 5 months and probably in the immediate future as well, folks are going to start to see some funding pressures. And what I would argue is really valuable for a lot of members would be thinking about quantifying the value of deposits. And this is necessarily part art and part science. But what I'm hoping to show with this and with a case study that's available on our website is that there's an opportunity to really try to bring some more science into this particular art when we're evaluating marginal funding strategies or overall business strategies in general, by actually trying to discretely value what a non-maturity deposit is worth. Why is this hard? Because non-maturity deposits are similar, but not really the same as bonds. I mean, from an accounting perspective, they're liabilities that incur expenses. But I think everyone would agree that they have real economic value to them. So how do we value something that doesn't have a stated maturity, doesn't have a guaranteed coupon, doesn't have a guaranteed life? And so this methodology that's sort of outlined on this slide and in greater depth on our website begins to give a methodology to try to think about that. And the good news is we already have a variety of ALM metrics, asset liability management metrics, that are available that we can use in this methodology to try to begin to put some numbers around what's our particular deposit worth. And in short, depending upon the beta that we have, that is the degree to which the deposit will reprice relative to the Fed funds index, we can start to think about bucketing the deposits into different types. One bucket, here identified as a core fixed bucket, that is price insensitive and not volatile. Those are deposits that basically theoretically are going to stick around. And we can identify that as 1 minus the beta. How do we think about that? If the beta is the degree to which the overall bucket will reprice relative to the index, well, what we're actually saying is, if we had a 50% deposit beta, effectively mathematically what we're saying is 50% of the deposits are fully sensitive and 50% of the deposits are not sensitive at all. So if we take that little mental leap, we can start to say 50% of our deposits in that example are not sensitive and they're not volatile, and they can be assigned a very long life. On the other end of the spectrum, if we take a look at our decay rate, we're saying those are deposits that are volatile. Those are deposits that could be gone in relatively short order. And from between those two numbers, that smaller bucket usually of high volatility deposits and core fixed deposits is the core float deposit, which is again theoretically deposits that will stick around. They're not very volatile, but you have to pay them. And so you have to pay them within a time frame, and we can identify that time frame as the lag term we're using in the NII modeling, the horizon over which it will take us to adjust rates. We've seen in recent months, for instance, here, obviously, Fed funds have moved very aggressively, but deposit rates haven't. So probably most folks have a lag term, whether they're actually formally incorporating it into the NII model or not. Functionally, deposit rates aren't moving, even though the Fed funds rate has moved very aggressively. So it's that horizon that we would use as the term for quantifying the value of deposits. And if we turn over to the next slide, we can start to do some math around that. If we put numbers around that and put that against the different types of deposit categories, you might be surprised at how valuable some of the less sensitive, lower price deposits are, especially as we have higher nominal rates in this environment. DDAs now as transaction accounts, draft shares. Those values, I think everyone would agree, those deposits and shares have very high value. But in this example, if we have relatively longer lives, you can see a valuation here of maybe 3% is the actual value of those deposits. And then as you get more aggressive in pricing, as there's shorter lives, as the decay rate is higher, as the lag term is shorter, the value of those deposits is less valuable. And as we think about different marginal funding decisions, especially with respect to introducing a deposit special, raising rates altogether across the whole book, or taking marginal wholesale funding, there's this marginal cost of funding analysis that a lot of folks are familiar with. That's valuable. I would just say there's other ways to think about it too that are complementary to it. And one of those is to quantify the value of your deposits more discreetly like this, and to say how much would have to change before the cannibalization that could occur with repricing deposits isn't worth it relative to just taking an advance. And I think irrespective of what numbers end up being put in here, it's very likely that you would see that it's only a few percentage points, it's mid-single digits percentage points of deposits end up being cannibalized by a special before you would have been just better off taking wholesale funding. You would have been just better off preserving the profitability of the book by taking an FHLB advance. And I think about that especially with the fact right now that so many folks are coming off historic lows in wholesale usage. I think overall borrowings in the industry at Q2 was about 3%. So very, very low levels of wholesale funding and borrowings out there right now. So as pricing pressures start to rear their head, there's a good chance it's going to make more sense to borrow instead of to raise pricing on deposits more aggressively.
Yeah, and I will say that this it can't be understated how important this is right now. And Sean using the analogy of the rubber band getting stretched a little bit, and deposit rates haven't moved, but they're going to, certainly as we have, more Fed hikes on the way. So, Sean has put together a very neat, calculator tool where you can have some simple inputs and assumptions and produce exactly what you're seeing here. We were able to share it with folks. So, and we found it to be very valuable. So, please reach out if that's something that you're interested in utilizing.
Yeah, and I also, just one other, I guess, quick asset liability management point that I would just want to highlight as we think about the kind of yo-yo effect that the market's implying on rates, higher rates, and then coming back down before very long. A good way to make sure that profitability is preserved on the balance sheet is with rigorous prepayment provisions in lending assets to the degree that we can do that. Obviously, it's not really feasible in most mortgage products, but on a lot of commercial lending products, it is feasible. And I think a lot of folks would be surprised if they really think about the math of kind of a simplistic step-down prepayment style versus a yield maintenance provision. And again, that yield maintenance doesn't have to be replaced with a treasury rate. It could be just replace the asset with a like kind of asset at a similar spread. This example uses that latter sort of discount methodology and just says, what if we had a $5 million asset outstanding for 7 years? And then 4 years or 3 years into it, rates decline 200 basis points. Rates just come right back down in 2025 to where they were not long ago. The economic value of that asset now is 7.7%. And if we had a prepayment provision that was sort of a 5, 4, 3, 2, 1, 0, 0 sort of style, we only collect 2%. But what might happen is you might say, hey, we collected a $100,000 prepayment fee, hooray for us. But economically, it was worth almost $400,000. So economically, we lost close to $300,000, $250,000, $300,000 economically. So the value of prepayment penalties has increased very significantly as rates rise. And thinking about managing that risk on the balance sheet is really key to the future.
So for our credit unions on the line, it'd be remiss if we didn't mention the NAV test. And it's been a challenge given two things that have happened. One is the asset growth driven by historic deposit growth has led to lower capital ratios. And then after that happened, we saw the rise in intermediate rates that put pressure on the market values of fixed rate loans and investments, far outpacing what the standardized values on the test were telling you your deposits are worth, which is frustrating because we know, as Sean said, it's art and science, but low cost funding in a high rate world is worth its weight in gold. So in terms of some things that you can think about to mitigate exposure to the test, if it's on the radar for you, is, that first bullet is easy for folks like us in our seat to say is, manage the income simulation. We're not the ones on the front line there, but if you know that you're asset sensitive, despite what the test tells you, then certainly you want to do everything you can to defend your position before you have to de-risk. But quickly go running through here, certainly delevering, maybe looking at what you have for monthly cash flow coming off your investments in mortgages that are, causing stress. Maybe say, okay, that's the number that I can afford to let some of the more rate sensitive money run off, because then there's a good trade-off. On the mortgage side, mortgage sales can help. And, there's a couple different options. You have the low coupon stuff that if you have some ability to withstand some income statement noise, maybe, that arithmetic works. If you were fortunate enough to put to portfolio some of that high 5, even 6% stuff, well, maybe you can get out at the opposite. You can get at higher prices now that rates have drifted back lower. On the investment side, given the path of rates, it's tough really to do too much other than the passage of time being your friend in terms of cash flow runoff. But I would be, if it works and it's needed, to be ready to take advantage of any, market rallies that may get you into a zone where you are able to sell and it works for, your earnings profile. On the funding side, two things that we have seen folks do. We talked about the HLB options, where some of those longer lockout periods can help you extend your funding duration, which is going to be positive for the, as it relates to the NAV test. And the other part is we saw how the yield curve is inverted between 1 year and 5 year, by about 20 basis points or so right now. So to the extent, again, that liability duration helps you, with this test, well then, at least comparison of a 1 year versus 5 year, it's working in your favor to push out. And I will note that, partially driven by, managing the NAV test, but also as Sean showed with some of the NII and NIM metrics, that there's a little more liability sensitivity in our credit unions relative to our banks. We have seen long-term borrowings from credit unions sharply outpace those of banks, despite the aggregate asset size being smaller. So, just something to consider there. So that brings us to the end. Thank you very much for your time. And, as Sean mentioned, on the website, we do have, we try to keep a relevant and active library of things. No charts on Red Sox 10-year correlation there. That's for this presentation only right now. But again, we thank you for your time. We're around. We're easy to find. So if there's things that we can help, either with some of the peer analytics or some of the deposit analytics, or even just a conversation where we can share some of the things that we're seeing and hearing, we are always more than happy to do that and be supportive to our members. So thank you very much, everyone, and have a great rest of your day.